Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and today we're getting an update from Cerrado Gold. Cerrado Gold is traded on the TSX.V under the ticker CERT and on the OTCQX under the ticker CRDOF. And I'm joined today with the founder and CEO of Cerrado Gold, Mark Brennan. And Mark, it's always great having you on the show just to get an update on all the operations. Just for people listening in, as a reminder, the company has three projects under the stable. They have the Minera Don Nicolas project in Argentina. It's a producing gold asset. You have the development stage and soon to be in the construction phase, Lagoa Salgada in Portugal, and also the Mont Sorcier project in Quebec, which is an iron project. So we're going to get into each of those projects, but we're going to kick it off with the news that you put out to the marketplace on August 21st. This is on your second quarter results. So obviously we're diving deep into Minera Don Nicolas. And for the quarter, you had 11,437 gold equivalent ounces at an all-in sustaining cost of $1,779 per ounce. So I think people looking at the current gold price will realize that's a pretty fat margin. And you still reiterated your guidance this year for 55,000 to 60,000 gold equivalent ounces from Minera Don Nicolas. So let's dig into the numbers here and get under the hood of Q2, Mark.
Fantastic, Shad. Well, thank you very much for having me, and very excited to talk a little bit about where we're going. I think the main thing is obviously we've reduced our debt very dramatically, and we'll continue to do so. Our expectation is that we'll reduce our debt by about $30 million this year, leaving us with a remnant de minimis debt, maybe $10 to $15 million. So we'll be in very, very strong financial shape as we move forward. But also we've invested and will invest between $40 and $50 million this year on our projects. So this has truly been a transitional year, on the one hand, to strengthen our balance sheet, and then on the second hand, to really put ourselves in a position to ramp up our production and cash flows. So that's where I see the most relevant element of the second quarter as being part of that transition. Obviously, we're moving away from production at Calandria Norte, which was our open pit operation. We've ramped up our production and completed the capacity requirement for our heap leach operation to get us to that 4,500 ounces per month, which hopefully, combined with our open pit operations, will lead us to exiting the year at around a 6,000 ounces per month run rate, somewhere in that range. And hopefully that'll be where our new kind of level of progression. But we're in the latter stages of that transition. But the second quarter and the third quarter are very much part of that. What we're looking at is that the costs are coming down. We were up at around $2,100 coming through the early part of the year, and now we're bringing that down to that targeted $1,500 to $1,700. We're still a little bit away from that, but we're getting there. And then in terms of, we're with the increased volumes that we anticipate seeing, that'll also help that all in sustaining costs. But the company is in my view probably better positioned now than it's ever been to see a ramp up in production, and to continue our focus currently to be producing a lot of gold and in these very high price environments.
Well, I think it's very significant that you've started the transition this year from not just the open pit material on the heap leach, but also the underground mining component. You brought that in as far as how that contributed this quarter. But maybe just remind people what a significant step change that is for the company. I mean, you had record heap leach production this last quarter, but having that underground development so important, and maybe talk about how you could continue to develop things and expand things in the underground.
Indeed. Thank you for highlighting that. Basically, we're looking at again, investment this year of about 40 to 50 million, predominantly 30 million of that plus probably at MDN. And the reality is that expanding the heap leach capacity will really help us to provide a consistent floor for our production of that 4,000 to 4,500 ounces per month. But in terms of the underground, we've started 3 portals underground in June. Our expectation is that we're drifting into the stopes, and the stopes are where we see the higher grade material. So there's de minimis production right now coming out of underground, but we believe that in October, production will start to ramp up. And the most important thing about the underground is not the ounces that we have in our profile today, but the ability to drill from underground and substantially expand our underground resources quickly. And those are high-grade resources. We were producing it on the Sulfuro vein as an open pit deposit at around 8 to 12 grams per ton. So we're hopeful that we're going to see that high grade continue below. But what we're really anticipating is seeing, like many other projects on the belt, our neighbors at Anglo's Cerro Vanguardia project, like our Pan American Silver project with Cerro Moro. Basically, they really started to see the rubber hit the road when they went underground. And now we have that added complement that we're just moving into, and we hope by year end that we'll have some really strong production augmented by some really strong evidence of exploration upside. So that's another critical element for us. We've also embarked on a separate exploration program of a minimum of 20,000 meters, but I think that'll just be a continual program moving forward because we're in pretty strong financial shape to continue that program. But basically, what we'll be looking at there is open pit opportunity of higher grade resources to drive additional resources and likewise fill the plant. We have a plant that is not part of the heap leach operation, and that independent plant will actually be fed the underground material, but also open pit material that we hope to be expanding very aggressively between now and the end of the year. So combined with the open pit and the underground, our objective for this year is to provide very strong evidence and confidence to the investment community that our current resource mine life of about 3 years, that we should be able to double that fairly comfortably. So that's what we're working on right now in this transition. I think once we've done that, we believe we should be trading at a much closer valuation to our peers on the gold asset alone, which if I look at some of our competitors out there, Cerrado in Brazil, to a certain extent, looking at Heliostar in Mexico, they have lower production rates than us and trading at 200 to 300 million valuation. And I think the one element that we need to improve is to really get that life of mine going. And I'll just remind people again, Chad, that basically what we haven't been able to do for a long time is substantial exploration here. And the additional capital that we have now that we're very strong financially gives us the ability to really go and find those resources. We brought in a new VP of exploration in the first quarter. He's got a tremendous history of finding resources, whether it be in the pyrite belt, whether it be on the Desierto Massif, whether it be in Mexico. And these are guys that you need, guys who have the ability to find resources. And so we're highly confident that by the end of the year, we'll be able to show with a great deal of confidence that we can double our mine life. And then on top of that, we see other upside as well. So from that perspective, we're pretty optimistic with the future for MDN, probably in the best position that it's ever been in.
Yeah, I think that's such a great point to highlight that you have initiatives in underground with all the drilling, the 20,000 meter program that you have, and underground drilling is so much better than surface drilling, but you still have opportunities at surface too. So you have kind of a dual-pronged approach there. You've staffed up the team. You have bigger revenues coming in to redeploy into exploration. And just as a reminder to people listening, you started this mine at a difficult time during the middle of the COVID shutdown. So it wasn't an easy time to get the mine started, and you're kind of bootstrapped in the beginning. But now that things are humming along and with the higher metals prices, you can reinvest in growth and reinvest in growing the mine life. I think that has been the knock against Minera Don Nicolas, but if you can double the mine life and continue to do so, I think people will see that this could have long legs like some of the neighbor mines that you've talked about that go very deep and have had decade-long, multiple decades in some cases, production profiles. So it's going to be exciting to watch Argentina continue to grow. Just one more thing to add to the mix as far as the strength of the financials of the company is that in addition to all the revenues and cash flows being generated, you also have the payment that you receive from Hochschild just here the week that we're on right now. Now that it's going to count towards Q3, not towards Q2, but maybe just speak to how that just throws another layer of capital into the company that you can redeploy into growth.
Well, what we did is we had a payment due from Hochschild in July of next year, and we received a prepayment at a slight discount to the initial payment of 10 million. We received 8.75 million. And really what we saw was we see strong opportunity to deploy that capital to reduce some extent of debt, but really to just show a very, very strong balance sheet, financial strength for anything that we may need to do going forward. We're going to end the year, in our view, with somewhere in the region between $20 and $25 million. This will help going towards that. We'll, as I mentioned earlier, we'll have spent anywhere between approximately $30 to $40 million on investment this year, and then we've also reduced our debt by about $30 million. So even with that, we've got a strong balance sheet, and on top of that, not only are we looking to extend our mine life in MDN, but with that extension, hopefully we'll see an expansion of the production schedule in terms of volumes. So it all looks pretty good. Everything's looking really, really good for MDN this year.
All right, well, let's pivot over to Portugal, to the Lagoa Salgada project. In Q2, you technically closed up all of the transaction of the acquisition of Ascendant Resources. So now that this asset is fully in the house and you're working on development, I believe the key is to get to a construction decision here by the first quarter of next year. So you've got a lot of different work streams going on to de-risk the project and working on the development side of things and engineering and metallurgical work. So give us a quick snapshot of the key catalyst on tap and that you've achieved at Lagoa Salgada.
Well, what's interesting, we acquired this asset on the Iberian Pyrite Belt in Portugal. I think we got a very good price for it. We have been investing in this asset, so we know it extremely well. The reality is this asset will probably look at doubling our production. And, the gold equivalent component of this will probably be somewhere in the region of 50 to 60% in terms of the asset itself. So as a company, our gold production will be 85% gold even when this asset comes into production. And what we're looking at is an asset that is going to be one of the lowest cost producers. It'll be high margin and high growth. We have lots of exploration upside to develop and grow this asset that we know of. Again, we have 27 million tons. Our reserve will be somewhere approximating currently the reserve on the last feasibility we did or that was done on the project is about 16 million tons. On the new optimized feasibility study that we expect to have in November, the reality is that the numbers are looking very, very strong. I think we're going to see an expansion in the resources. I think we'll see from our metallurgy, we're going to see higher recoveries, higher grades, lower costs, lower capex. So we should see a fairly substantive advance on this feasibility study. And to your point, we've got backers behind us who want to help us fund the project, and our expectation is that we will complete the funding by the first quarter of next year to bring this into production. Our hope will be at the end of the second quarter, early in the third quarter of next year. It'll take about 18 months to construct, but we're looking by the beginning of 28 to be generating another $100 million from this asset. So from that perspective, once we bring this project and complete the financing, we can kind of ring fence it, and we still have all this cash and cash flow generation from MDN to sit on our balance sheet and grow MDN.
Well, I think it's important what you mentioned at the onset there about the growth in the precious metal side of the business with this asset. I continue to hear people say like, oh, well, this is a critical minerals or a polymetallic deposit, so I wish they had stayed more of a precious metals company. But to the point you made, Mark, you will have about 85% of the production profile in the precious metals. And I think it gives you an interesting kicker to have these critical minerals in here. Just as a reminder to folks listening, you got a lot of different metals, but you got a lot of gold and silver in there, but you also have some zinc, some copper, and some tin. And those give you the angle to possibly look at some funding options for the critical mineral side of things. So maybe to speak to how precious metals project, but the critical minerals kicker gives you some optionality on the financing package.
Indeed. Well, to your point, I mean, I think that most projects in the Pyrite Belt have a very significant component of copper and zinc, and we fully expect that we're going to find a lot more copper as we move forward. The project is somewhat zinc emphasis at this point, aside from the precious metals, which is more substantive. But at the same point, there are a lot of advantages in this critical metals in terms of the European requirement and desire to have self-sufficiency. And so what we're looking at there is it's been advantageous in terms of permitting and licensing, in terms of community and governmental approvals. So having this critical metal component will give us a good kicker from these metals, but at the same point, our company remains a gold company and a precious metals company with 85% of our production coming from gold.
Well, and I think that it's going to be a great project number two to kind of sink your teeth into the development stage and to get it into production by 2028 isn't that far away in mining terms. So a lot of wind at the sails of the Lagoa Salgada project, and I'm sure a lot of more news flow that will be coming out to the marketplace as you continue to de-risk it and hit some of those different catalysts. Let's work in one other project though that is an iron project, but it's a little different in that it's incredibly high grade. It's in Quebec, so it's in a friendly jurisdiction, and it just gives you some optionality as far as moving this project forward. You're working towards a feasibility study here, and some people hear iron and Mark and they yawn and think, "Oh, iron, like I'm not interested." But talk about why this is a little different than your typical iron project and why it's a nice value lever for the company to pull.
Yeah, and again, the right now we're going through the technical element of completing a feasibility study. It should be completed in the first quarter, early in the second quarter of next year. But basically, what we're looking at is a project that is a very high grade, high purity DRI, direct reduction induction furnace quality, which really means that it's the highest grade and standard that you can get in the iron ore business. And the importance of that is that the demand for this product is substantial. If you look at the iron ore business as a whole, it generally grows at about a 1 to 2% clip per annum. This material is growing at around 9 to 10% per annum. So what most smelters are trying to do is they're trying to add 10% of this material to their furnaces, and there's just not enough of this material around. We have a very big project, 1.1 billion tons at the moment, and that has plenty of room to go bigger. But on top of that, we're looking at an open pit, high grade, high margin, fantastic infrastructure, jurisdiction in Quebec, which is a very good mining jurisdiction. All the ingredients there are right. But again, our focus now is our team in Quebec are driving the feasibility study. They're doing a great job. And, getting this feasibility study complete will give us, to your point, perspective on which to see how the company is going to go forward. But at the same point, our focus right now is really getting MDN to maximize, optimize that production, take it beyond that 55 to 60,000 ounces per year, and with the additional mine life. Next step will be, looking at bringing our project in Portugal to production. But even with those two assets up and going, we're still running at about 85% precious metal production.
Well, Mark, just one other point I want to make is about the valuation of the company. I would love you to share, just in a very brief sense, what the NPV is projected to be at Lagoa Salgada and what the NPV of Mont Sorcier is supposed to be based on the most current economic studies that you have, just as a point, and then reflect that against the market cap that you have currently, because that's not even figuring in the producing gold asset at Minera Don Nicolas. So just talk about the underlying value proposition of the two development projects and how each one of those could independently underpin your current valuation right now, not even counting the gold production.
Agreed. I mean, it's a little bit of a dichotomy, but anyway, I think as we de-risk and show this project in Portugal is going to be coming into construction, let's call it by the end of the first quarter next year, I think that you're going to see a lot more attention given to it. Now, in the feasibility studies that we completed in 24, our expectation is for that asset to be, that asset was at 150 million MPV. Our expectation is that we will see a substantial increase on that MPV in the current optimized feasibility study. I would say that probably most assets of this category trade at about a 0.8 times multiple. Let's put, by the end of de-risked in terms of construction and capital, an investment decision to move forward. Let's say you put that at about a 0.4. That alone gives you 75 million US at a minimum that we could see this share price addition. And that, to your point, would probably put us right at a fair clip on the market cap where we are today. If you look at our PA that we completed in the iron ore project in Quebec in 2021, basically what we're looking at there is a study where, we had a 1.6 billion NPV. We're probably going to see some inflationary creep there. We're going to see some cost. OPEX is still pretty much the same. But again, we're going to see some margin improvement as a consequence of the high-grade material that we didn't have in the previous PEA. But let's just say we retain our 1.6 billion MPV. I think you could easily put a zero point 0.1 times multiple on that post feasibility. And I'll just remind you again, on this project, we have TD Bank as well as UK Export Credit Agency who would like to fund this project to help us bring this into production. So we already have strong backers for the project finance of this project. But anyway, if you put a zero point 0.1 times, that's 160 million US, which would give you another $1.50 per share. So from that perspective, we see strong value. With our expectation is to see the iron ore asset in production by 2030. So that's, just over 4 years away, which isn't too far away. But at the same point, driving just a lot of cash flow. And our emphasis, we love the precious metal business and we want to stay in that business in a big way. But at the same point, our ultimate objective is to drive cash flows. By 2030, if you brought all three projects into production, we would be doing somewhere close to $500 million of free cash flow.
Yeah, I just think it's important to highlight just how valuable these development projects are in the mix and how each one of them independently would actually underpin your current market cap. Again, if you just used a 0.1 multiple at Mont Sorcier, that's still 160 million if you do it that way. Because it's $1 billion project and it'll get more valuable as you continue to de-risk it once the feasibility study is updated. And then obviously as it goes into production, those multiples will increase that analysts look at. So I think there's a lot of hidden value in this company that hasn't quite been daylighted yet, but there's a lot of value drivers coming up. And really, the engine that's driving everything is the production out of Minera Don Nicolas, and we're going to continue to see that asset expand through exploration, but also through production growth in the underground. So exciting times with Cerrado Gold. There's going to be a lot of news flow from the company. And so for those of you listening in, definitely click on the link below in the show notes. It takes you right over to the Cerrado Gold website, straight to their news section, where you can sign up for updates and have them hit your email inbox, or just follow along with the news as it comes out to the marketplace. I'm sure we'll be getting you back on for an update pretty regularly, Mark. And as always, looking forward to our next conversation.
Shad, thank you so much for your time and for the update. I hope we'll be back shortly with some really good updates for you all.